a number that really stuck out, of course, is the fact that provisions for bad debts doubling to 1.1 billion rand. That's making up 7.6% of the total book. Are they being prudent here, or do you think that they are just giving a signal to the market that things might be going wrong going forward? How are you reading into this number?
You have to realize Capitec are very prudent. They write off all their arrears after 90 days. So if you missed a few payments after 3 months, they'll just write off the whole debt. And if you look at their numbers, the actual bad debt ratio has been coming down from about 12% of loans to 10%. So the increasing provision that you're talking about would be a provision for arrears within the 3-month period. And the fact that they put the provisions up shows that they're just being more conservative, putting more money away in case more clients default in future.
Patrice, Capitec for me has obviously just been such a star performer and made a lot of clients very happy. And I think this set of results, really gave a lot of confidence to the share price and the level of the share price that you're seeing at this point in time. But, stocks tend to look forward in nature and, looking 6, 12, even 18 months out from where we sit at this point in time, how do you see growth for Capitec looking forward to those timelines? And do you think that the market that they're operating in at this point in time is not saturated? I mean, how much more growth is there for a stock like that to have in the short term?
Look, it's a very good question, and I think the one indicator of growth that we can look at is the growth in the number of clients. And it's interesting how their growth is still very strong. I mean, they've grown their client base from 2.5 million to 3.2 million clients. I mean, that's a huge footprint, given that the other banks, have built their client bases over decades. If you look at Nedbank, their retail client base in terms of primary accounts is probably 1 million clients. So Capitec is really grabbing a big chunk of the mass market. And it looks like they still have a lot of growth by simply extending the term of the loans and the fact that their loans are still very small. They disclose the fact that the average size of loans is still under 3,000 rand, which is quite small. So they could actually grow their book by offering much larger loans.
Yeah. Patrice, with regards to the cost-to-income ratio, that declining to 46% from 51% is the best number that we've got in South Africa. Are these kind of numbers maintainable?
Well, again, it has to be a low-cost operation. It's monoline, so it doesn't offer as many services as the other banks. You would have to compare it more to African Bank, which also has got a very low cost-to-income ratio. But as you say rightly, I think the income is what's been growing very strongly, and if that slows down in future, then obviously the cost-to-income will be ticking up again.
Fantastic, Patrice. We have to leave it there. Thank you so much for joining us. That's Patrice Rassou joining us from Cape Town. For you, Deryck, would you be buying into have you enjoyed the rally? Are you one of the investors that is smiling right now?
Yeah, look, I think, to be honest with you, I actually got out Capitec a little bit too early. So it has run a lot further than what I thought. But at these levels, very fundamentally full. I'm concerned about whether they can continue to produce the set of statements that they just did. And
we keep saying this during every result season, Deryck.
We do, but it comes down to a fundamental calculation for me. And I say, would I buy an expensive stock like this? Will it stay expensive? But at this point in time, I definitely think about taking some of my profits off the table.